So we will be discussing, welcome again. So we'll be discussing IPSAS 12 or IS2 inventories, and I will talk about more of this IPSAS. I will talk about more of IPSAS 12. IPSAS 12. The equivalent in the private sector is IS2. IS2. So my assumption is you know what inventory is. I will be dealing with an example, a practical example. So what's inventory? Inventory can be defined as an asset held for sale or distribution in the ordinary course of operations. Inventories can also be defined as assets in the process of production for such a sale or distribution. So basically those are the work in progress. Also, inventory can be defined in the form of materials or supplies to be consumed in the production of goods or services, then held for distribution or no charge or nominal charge. So those are definition of inventory. Inventory are raw materials. Inventory are what can we say, are work in progress. Inventory are finished goods. So those are typically what I just said in that explanation. And my assumption is you have gone through inventory. You have gone through the measurement where you say lower of cost or net realizable value, or lower of cost or and current replacement cost. What methods we normally use: the FIFO, the LIFO, and the weighted average. In the public sector, we encourage people to use the first in, first out method, the FIFO. So I expect you have gone through all those, and we have now a practical example. In this practical example, this is the question. In this question, question 1, you are the accountant for account department preparing financial statements for the year ended 30th June 2026. The department holds 3 distinct categories of inventories. So, and I will base my argument on the disclosures. So inventory, you can add inventory in your books using 3 methods, using the following ways. Number 1, through purchase, when you buy inventory. 2, through donations. 3, you can also get inventory through transfer from other assets, like biological assets, through transfer. You have changed from biological assets to. 4, you can also add inventory. So this can only increase inventory. It won't change the number of units that are available, but it will change. So reversal of write down. So these are some of the ways you can add back or increase your inventory value. So these are ways you can increase your inventory value. Then someone might ask, how do we remove inventory from our books? How do we remove? So the one is sell. If you sell inventories, the other one is through consumption. If you normally consume those toners, those papers. The other one is through transfer from one asset to another, like it is inventory now, and then you have transferred to PPE through write down itself. Through write down, and then there is a write off also, which forms part of the write down, but that's a write off. So and then you can distribute, which is also close to transfers. So this might form one, these two might form one, write off and write down. So these are 5 ways. These are 5 ways, 4, 5 ways. So the first one, adding 4 ways, removing 5 ways. So we'll come up with a table for the movement, a table for the note, the main note, and a table for the expenses. For the expenses, I think I won't be doing, but I will explain how it is done. Thank you. So we will start with the fertilizer. This is the first scenario 1. You had an opening balance of 0, an opening balance nil. Purchase is 20 million. Distribution is 15 million. And then the write down, the amount, the loss is 250. How can we get the write down? For example, current replacement cost, CRC, is 1 million. But you bought 1 million. But you bought this item for, say, 50. So it has lost a value of 250. So the write down is 250. The write down is 250. So let us see how our movement schedule is, and my solution. The movement schedule is something like this. It's something like this. It has description. Please check the heading. It has the classes, class 1, class 2, class 3, and then the total. Very important. This is the movement schedule. Before the movement schedule, we will have another table whereby we will have the current year and previous year and the description. So this is the table. This is the main note. The main note will have fertilizer, for example, class 1, fertilizer, class 2, seedling, class 3, surface. So these are the classes, and then the opening will go here. Opening will go here, and here you will have closing. You will have closing. Here you will have closing balances. Like what you will be dealing with is the carrying amount. What you will be dealing with is the carrying amount. So this is, say, note 1A. Then here is note 1B. And then for the expenses, we will call it note 1C. And also other disclosures. In fact, you can put other disclosures under this note of inventories. And then the amount you will transfer to expenses you will show here. So how much was our purchases for fertilizer? So we are dealing with this column. 20 million. And then the amount we distributed is 15 million. The write down is, so this is what will go to expenses. The write down will go to expenses. I think if you look at my table, the headings I explained, let us go to this side of the description. It has opening balance. When I was talking about addition, I said purchases, transfer, this cost incurred, etc. Someone can have those additions in as a broken down item or as a line item to make your disclosures clear, because at the end of the day is for the public to understand this information, for the users of this financial statement to understand this information. So that is for fertilizer. By addition, we have those sections. Expenses, we have inventory expense, inventory distributed, billed, lease losses, the write-off, the valuation adjustment, the write-down, the reversal of the write-down. You can see those sections. So you can make it clearer by coming up with an inventory movement like this. Let us go to question 2. Question 2, the opening is 500,000. The harvest additions is 2 million. And then what was given out is 1.2. And the loss is 80,000. And the a reversal of the loss is 50,000. So opening there you can see 500. The addition, it is 2 million. The distributed amount is 1.2. Up to here, every person gets it right. But where the problem might arise is this. Inventory was stolen. How much? 80,000. In government, you can't just write off what was stolen, for example. Why? Because there are law, there are regulations. In Kenyan law, under regulation 148, an accounting officer is only allowed to write off how much? You are allowed to write off in one instance. Maybe if this inventory was lost in several instances, it's okay. But in one instance, you can only write off up to 100,000. Anything more than that, it goes to the cabinet secretary, the CS, which we normally refer to as CS, National Treasury. So, and then there is a certain percentage that will also go to the cabinet. Please refer to regulation 148 under losses and write-off. Okay, I think it is 145, between 145 to 159. So those regulations all cover and talk about losses and write-off. PFM regulation 2015. So 80, since 80 is within the PS or the accounting officer, then this is okay to write off. This is okay to write off. And then once you write off, it is an expense, so you minus. Purchases is addition. Distribution is minus. Write-off is minus. And then reversal of write-off. What will happen? Since you are adding back to your inventories, and I explained, you will write what you have written off is what you reverse. Circumstance change. That lower of cost, the initial cost, and the current replacement cost. The current replacement cost you underestimated too much. Now you have recovered from the lower figure, but you haven't reached the what can we say, the cost. So it should not exceed the cost at one point. At any one point it should not exceed the cost. So you reverse this 50,000. You reverse. So when you are reversing, you increase, you debit your asset inventories, you debit asset and credit the expenses. The only, what if you don't have an expense for that period? What will happen? Then you deduct from the other expenses like use of goods, where you putting that you reduce that expense, because you can't treat it as revenue. You deduct from an expense. You can't treat it as revenue. And IPSAS guides that you reduce the expenses for inventory of that period. In the unlikely situation of not having an inventory effect, then my take on or opinion is you reduce from use of goods, okay, as an adjustment, since you can't treat it as revenue. Okay, let us once you total, you get this amount. And then let us go to services. These are architectural design services. Opening balance 200,000, cost incurred during the period 1.5, completion is 1 million. So what are these services? For example, Auditor General can have services. They can provide services. Architects can provide services. They can provide services. So these services, you can account them as inventories before you bill the entity. So how do you do it? So the opening balance is the 200,000. The addition is the cost incurred during the year. And then what you billed, the 1 million you billed, you invoiced the entity. The 1 million you invoiced the entity is the minus, because what happens when you bill, you reduce your inventory and recognize a revenue. If you received cash money, then what happens? If you received the money, what happens? Then you debit your cash and bank, or if you have not received money, then you debit your receivables. And this is not normally common in public sector, but to few entities. What if it is a service that you are not, what if it is a service that you are giving to a non or an entity for free? Maybe what you can say is that you first write those costs, and then wait until you complete, and then the period you have completed is when you recognize your period. But IPSAS allows you to write off or follow this inventory method. So we have solved the 3 examples for inventory. Now let us see what we will be disclosing in our books. So the first thing we will disclose is the valuation policy. What is our policy? What is our inventory policy? And you will say the fertilizers are measured in this, the seedlings were measured in this, the surfaces were measured in this. Were you using FIFO, LIFO, weighted average? And then the carrying amounts, of which it is our 1A, where we will have our opening and closing, the carrying amount at the beginning and at the end of the period for those comparative years. And then we will also mention in our disclosures. 3, we will do a note 1C, for example, for our inventory expenses, whereby you will see in a form of a table for class 1, this is the expense, class 2, this is the expense, this is the write-downs, and this is the recoveries. This is the recoveries. The recoveries reduces our expense. The usage was 17.2, the physical loss is 80,000, the valuation write-down is 250, and the reversal of write-down is 50, and this gives us a total of 17,480. And then after this is whether you used that inventory as a security. So you say no inventory was pledged as a security for liability during the year. No inventory was used as a security. So you can refer to the disclosures that is given, and you disclose all this information, because the moment you just put figures in our financial statement without the narrations, then it becomes difficult to understand. Remember, our motto is transparency and accountability, so we will be more transparent. We want people to understand those information in the financial statements. There are gray areas. Like, for example, spare parts. Some spare parts are of low value, others are major value, so there is a risk. Then under paragraph 11 it says that inventory includes spare parts other than those dealt with PPE. If it is an engine, it goes to PPE. If it improves the value of that asset, then you treat it as PPE. If it is just the oil filters and etc., then it is inventory. Strategic stockpiles. The confusion is that some stockpiles you might hold them for more than 1 year. And inventories, their nature is only they are consumed in the course of the entity's operation within 1 year, etc., or 12 months. So what will happen if you are holding for 3 years? Then it is not a PPE. Because the fact that it is consumed or held for consumption, then you will treat it as inventories. You don't look at the value. As long as it is held for consumption, then it is inventory. Even if it is a house and the aim is it is held for consumption, then you will treat it as inventories. What do we call the normal capacity when allocating overhead costs? Number 3, those are the other gray areas. What do we call normal capacity? Normal capacity is you normally produce 10,000 units of goods. 10,000 units for a certain figure, a certain overhead cost. And then when you are allocating to each inventory, you take the whole amount divided by the normal capacity. But what if, due to budget cuts, you produced 1,000 instead of 10,000, but the rent remained the same, the overhead rent remained the same? So if you take and divide the way you are doing before, then you will overstate your inventory cost. You will overstate the inventory cost using the overhead cost. Therefore, what we will do is the balance. If you have produced 1,000 and you used to produce 9,000, the balance of the overhead cost you will immediately expense. So here, this is asphalt plant produces 10,000 tons. The year due to budget cuts only produced 1,000. The factory rent is 1 million. So what we used to do is 1 million divided by 10,000. Divided by 10,000 times 10,000 units produced. So we used to allocate the whole 1 million to this 10,000. But if you have only produced 1,000, so you will minus 1,000, and then you say this, and this is equal to how much? 100,000. The 900,000, this is equal to 100,000. The 900,000, you will take it to an immediate expense. The 900,000, you'll take it to immediately expense. Why? If you take the 1 million as your expense to produce your 1,000 tons, then you have overstated the value of your inventories. That was the end of my example, a practical example for inventories in the public sector. Thank you for listening to me, and enjoy your day. Thank you.